the market is constantly changing. So what works for 3 months is probably not going to work for 12, which means, if you have that black box algorithm, there's going to be times when it absolutely backfires and doesn't work. And, you see that like in a bull market, when everything's going up, sure, that can work fine to do momentum-based AI algorithms and say, hey, this company just broke through its 50-day moving average with this 20-day moving average, and that's always a bullish signal, so I'm going to buy there and hold. And that works great when everything's going up, but not so much when things are going down, not so much when global events are happening, when governments are changing policy. So I think the biggest misnomer out there is like the AI will solve all my problems. You still have to be able to think, and you still have to be able to understand how to apply it in different circumstances.
Hello, ladies and gentlemen, and welcome to our interview with Andrew Einhorn. Andrew is the CEO and co-founder of LevelField, which is an AI-driven fintech application that automates investments research so investors can find opportunities faster and easier. So, Andrew, welcome to our Risk Management Show podcast today.
Thanks for having me on. Appreciate it.
Absolutely. Thank you very much. I believe that we will have a very thoughtful conversation on the topic of simplifying investment research and using AI for stock trading. But before that, could you please tell us a short story about yourself, your career path, and what you guys at LevelField are up to today?
Sure. Yeah, happy to provide a little bio. The short version is I've had a kind of an interesting traditional career. I actually started my career as an epidemiologist, coming out of university with a degree in psychology with a heavy focus on statistics, and started early in the career kind of identifying contamination sources, things like how did the mercury get in the tuna fish and things like that through statistics. Went into consulting for a company called ICF International, was there as a senior consultant when they went public, was doing all kinds of work for different government agencies and non-public agencies as well. Things like helping to regulate commercial space transportation, building metric systems for NASA. We built environmental and occupational health risk management system for the Defense Department. And that kind of just at that point fell in love with the process of creating technology. There wasn't something that was just off the shelf technology we could buy for the Pentagon. So I had to work with vendors and basically build a system that would, span 13 different countries and thousands of people within DoD. And I loved it. It was a 3-year gig. I was able to kind of architect the tech and realize that was what I wanted to do more than consulting. So I started my own tech company after that. And it was largely geared at using publicly available information to identify threats and risks and different types of events for public companies. We had companies like Discover Card and Exxon for clients, CSX and things like that. And there were always events and different issues that were happening. So the software would kind of automate the collection of that information, identify how big a reputational threat it might have been, or in some cases, positive feedback from the marketplace, the news, and social media. And then we'd relay that information in the form of alerts. And so we saw over many years and many different clients, these sort of pathways of information. We got really good at analyzing unstructured data, right? Free text form and turning it into structure. And then the company was successful. We grew it from just a napkin sketch to eventually selling it in 2019 to a large private equity shop. At that point, we took a little bit of a breather and started kind of looking back and saying, what kind of things could we have done better? There was some thought about, the barriers to doing this with Boolean searches. And so we started working to develop some AI to compensate for the linguistic challenges that traditional searching in unstructured text happen. And anyone who, has been using Google for years has experienced this. You put certain keywords in like a last name, And instead of the politician, you get the football player and things that nature that are just not taken into the context and sarcasm and humor and things like that. So we were kind of generally working with AI, trying to figure out, what we wanted to do next. We had the same technical group from the previous business. And then as we were kind of searching for different problems to solve, COVID happened. And the world kind of stood still. We took the big pause, everybody got locked up, and the market started crashing. And it was at that moment we were kind of talking with friends and family members who were scared about losing all their money in the stock market, that we realized that, hey, really what's happening right now is there's this event and nobody knows how to react to it because there's no data set, there's no playbook for how do you react to a pandemic of this size. I just happen to be an epidemiologist, and so I went into kind of my study and said, let's figure this out. Like, how bad is this going to be? What is the government response going to look like? What's the death rate going to look like? How long is it going to affect markets? And it took about 80 hours to get that answer, and came out and thought, you know what, it should be a lot faster to get an answer like that, because when an event happens, you don't normally have that much time to react. You need something quick. You need to make a decision fast. And so that was kind of the inspiration for LevelFields, which is an event-driven analytics software platform. And so the idea behind it is we have thousands of stocks in the stock market. Events are happening to those companies all the time. They're making announcements, they're losing money, they're making money, they're merging, they're acquiring, they're firing, they're hiring, and so forth. And the question that every investor then has to face is, what do I do with this information? How do I react to that information? And largely right now, the market has been kind of a gut reaction, right? Like, I think it's bad, so I'm going to sell, or I think it's good, so I'm going to buy. But there's not a lot of necessarily insights or benchmarks into telling you, well, how bad is it going to be? How long is this going to take, right? How low is the stock going to go in an event like this? Or how high is it going to go? And so you have these natural cycles where an event takes place and the market either underreacts or overreacts because there's no real clarity on, what normally takes place. And so that's what we wanted to solve for. We wanted to be able to give people the chance to not only monitor at scale using AI, all these different, thousands and tens of thousands of events, and look for opportunities in the market and be able to do the research much faster, but also give them kind of the decision-making tools to mitigate some of those risks by overpaying or overreacting, right? And Jeff Bezos leaves Amazon. It is not the end of Amazon, as we see. It just hit new all-time highs, but a lot of people thought it was, and they started selling. And if you had our analytics platform, you could have pulled up the data on that and said, oh, wow, look at this. After 2 months, when large cap tech companies have CEO departures, the share price goes right back to the previous closing price before the news of the departure, and often goes on to make new all-time highs. So there was actually a 13% dip in the price of Amazon on that news. That's a buying opportunity, right? That's the opportunity to make 13% in 2 months. Most people are looking to make 7-8% a year. So to do 13% in 2 months is pretty amazing, and that's the kind of advantage that the tool provides.
Yeah, interesting. So you explained some common challenges that investors face in analyzing stock market and how probably AI can help overcome these challenges. But can you explain how AI is currently being used to simplify investment research, maybe in more detail? Because you said one example of Jeff Bezos, but is it just relying on one kind of example? Can you build some models and patterns?
Oh, sure. So yeah, what we do is we break out events by type, right? So CEO departure is a type of event, and in a given year there might be 500 or 600 CEO departures from public companies. All the companies are a little different. Some are big, some are small, some are healthcare, some are tech, some have good financials, some have terrible financials. And so the reactions of the market really depend on those factors. And so what the AI can do is, with a click of a button, you can see past reactions by type. So if I want to look up, just give me mega cap tech company CEO departures with positive revenue growth and positive earnings, I can see that for those companies, there is a dip. It's a buying opportunity. There's a mean reversion and it hits an all-time high, like the Bezos example. In other cases, you could say, you know what if it's a small or mid-cap healthcare company with no profit and no revenue, and the CEO leaves? Often you see a celebration because the company was struggling. And so the stock might be up 26% that day on the hope that, somebody else can come in and turn things around. So that's one event type. And we use AI to sort of collect the events. And effectively what the AI is doing is like a speed reader. It's reading through 30,000 documents per minute. It's looking for specific types of events that we have correlated to market movements. We call them material events because we know that they're going to move the share price either north or south. And it extracts those events in really a couple minutes from the date that it's published, processes the information, matches it to the appropriate company, pulls the ticker, matches it to the financial data of the company, matches it to real-time or near real-time stock price movements, and then can send an alert and say, hey, this just happened. This met your criteria. So you could set up kind of like AI search bots to say, you know what, I'm interested in these types of companies and these types of events. When, let's say, Tesla does a product launch, I want to be alerted. Or when, company is doing a large dividend increase in the space that I like, which might be industrials, let me know. And you don't have to actually go out looking manually for this. You just set it up once and it will come to you again and again and again. And so that's one way that our users use the platform, sort of trading on that information or using the information to monitor existing holdings or potential holdings. And so what we do is we build up different event types. We call them scenarios. And so there's about 25 different scenarios on the application. And, there's different ways you can use the data. For instance, when the war broke out between Russia and Ukraine, we saw really interesting changes happening on the events. We saw fertilizer companies, coal companies suddenly doing really huge special dividends, giving massive amounts of cash, 8-9% of the share price value back to shareholders. And so all you had to do was know about that. You buy some shares, on the record date, and within a month, you'll be distributed large cash. But the question was, well, why, right? Why were these companies doing well? And that was an indication that something was happening in these sectors. And so you quickly look up, coal price, and you see the coal price was up 100% because Russia had shut off gas to Europe. The Europeans needed energy and they started burning coal instead of natural gas. And so that demand pushed up the price for coal. Likewise, with fertilizers, a lot of them were coming out of Belarus and Ukraine and Russia. They could not export at the rate that they could before the war began. And as a result, the price of those fertilizers went up. As supply came down, demand went up. So companies that were based in Canada or the US that had no problem shipping their commodities could then ship them out for twice the price or sometimes 3 times the price with no extra cost to them. And so that resulted in massive profits. And there's just an example because it's very kind of tangible about how you can use these sort of events as indicators of, economic, like macroeconomic headwinds or tailwinds. And in many cases, we see that, in the AI sector now with companies, coming out and doing similar and doing huge stock buybacks and creating dividends for the first time. And you're seeing, those companies, everybody knows about sort of the Metas and the Alphabets and the Apples, but probably haven't heard about, the super micro computers until it's up 600%. But these events are able to spot that early and often. And so you have a greater opportunity to sort of get in earlier before these sort of big moves happen, before, CNBC and the analysts start talking about it.
Yeah, exactly. Yeah, interesting. Actually interesting because of this you said about fertilizer companies, and I was interested in this sector just in this period. And I know that there are some buy signals, but you never hear about cell signals because I think well, after 1 year the fertilizers were all crashing down about 50%,
Mhm.
and all gas companies and Europe also was a kind of spike, and then it was also then a very big downturn.
That's right. And that's a lot of what we see in the market these days is there's some kind of cycle, economic cycle, or there's some kind of external event that drives the share price of an industry up or down, and usually it doesn't last. It's there's going to be a boom, and there's always some kind of bull run somewhere, depending upon what the event is. And being able to find it quickly is key. And a lot of the way the market is sort of managed or maintained now is through the news media interpreting information or filtering information and then bringing it to everyday investors. But there's a strong bias of the media in that they want to get attention. They want to drive clicks. They want to grow advertising revenue. In order to do that, you have to have sensational headlines. You have to talk about the companies that everybody already knows about and wants to read about. And so if you look at the coverage, there's a massive amount of coverage on only a handful of companies. You always hear about Tesla, Apple, Amazon, Microsoft, and so
Yeah.
forth. And that drives the clicks. But there's 6,000 other stocks just in the US market that you
Mm.
could also be looking at that never sees the light of day. You don't see it until after there's a 200%, 300% move. And at that point, if you pile into it, your risk reward is not great.
Mm. And you guys working on or USA stocks or kind of worldwide coverage?
Right now on the platform, we have everything that's traded in the US markets. That includes foreign stocks and ADRs, whether it's a BHP or an AstraZeneca. Um, we on the back end of the system, we are processing a lot more data than that with plans to sort of roll out for different exchanges, but we're not doing that just yet.
Mm. So, can you share some perhaps ethical consideration which investors should keep in mind when using AI for stock trading? I know there are some maybe people, as I say, information bias, whatever, because some people using Bloomberg terminal, professionals, and they probably see some information more than normal investors. But what do you think about it?
I mean, we're on kind of the other end of the ethical side, which says it's been unethical to have this huge gap in resources and really education about the market that existed for years and years, decades, where a small investor can't possibly track more than 20 or 30, 40 stocks. And you have these large, hedge funds and institutions with hundreds of analysts being able to pour through the material. And what they have done, and they find the best ones, they buy it, and then they, go showcase them on television, say everyone else should go buy it, usually when they're selling it. And so it's
Yeah.
a lot of market manipulation. And so we started LevelFields on the premise, and it's built into the name of leveling the playing field for an individual investor who now has, with AI, the same power and the same advantages that these large, asset management shops can have. But you can do it with, one person with one technology system and at a price point of only a couple $100 a year, so everybody can afford it. And so, we're very bullish on the use of AI for investing. I think we're not a trading app in that it's not automated. There's still a human pushing the button to make the decision at the end. We're really an information service. So we provide kind of better decision making. We provide, automation of the research process, automation of idea generation, automation of the monitoring. But we don't trade through the platform. And so the automated trading, I think, can get a little bit out of control. If was to just use solely AI to go make trades, there's certainly that in the market today. And every once in a while, you see the algorithm kind of go crazy one way or the other, or get something wrong. Um, I have, some friends who work in like the pharmaceutical sector, and they'll say, "Hey, the AI clearly got the headlines wrong because it was a readout, from a clinical study, and the first part of the headline might say did not meet, endpoint, right? Means the trial didn't go very well, so the drug is a failure. But the second part might say, but we're using it for a totally different and bigger problem. and all of a sudden you see the share price dive of the stock, and it goes down 4 or 5%, for 2 3 hours, and then comes right back up and becomes, positive, as there's a human validation afterwards. So, it can be a little dicey to allow the computers to do all the trades, because that does happen. Likewise, I think there's opportunity for manipulation, which, always happens in the stock market. There's always somebody seeing to be inside a courtroom. But we see, if you were to say, like, fake a headline, knowing that AI systems would trade on that headline, then you could really move a lot of stocks simultaneously. So, my personal view is, like, you should always have a human in between the machine and the decision. And we do see, in some cases, someone will leak something to a journalist. The journalist writes the story. The story is a rumor. It's not confirmed. If we were just doing machine only trading, that's going to be a problem, because it's not, I guess you could get it to validate that particular piece of information if the validation exists. In some cases, it doesn't exist. So we see this a lot when, like, activist investors, which are one of our scenarios, they'll invest in companies, they'll buy 5% of the company and push for changes, right? They have to do a filing with the SEC to declare, their ownership interests. Sometimes it's leaked that the activist has taken a big position in a company before the filing becomes public. And you can't verify that. So just, it's maybe a Reuters report, and it'll say sources familiar with the matter will say that, Elliott Investment took a big position in this company, but there's no filing. There's no evidence of that. There's maybe a conversation. There's maybe a fact. So do you trade on that? Do you not? That becomes an ethical consideration with the AI. And if you train the AI, hey, if there's no SEC filing, don't put this information out there. Then it actually is better than the human pieces that are coming out. So, it can work in a variety of different directions, but I don't see it going away. I see it more like, if once upon a time you used a hammer to build a home, AI is now the nail gun. So you can do a lot more in a day and get a lot more done. I'm seeing different use cases all the time of AI, and we're integrating, third-party AI in some of our marketing efforts, just to speed up some of the processes of, like, video generation or editing, things like that. So I think that's going to be, the next 10, 20 years within finance, we'll just find a lot of things we can do more efficiently. I don't think it means the death of people working in finance. I think more likely, you'll see a lot slower hiring, companies being a lot more productive, being able to do a lot more with a lot less, and they could, double or triple their size without doubling or tripling their workforce. So, with an aging population globally, I think it's a good thing.
All right. So you already named some future trends, but perhaps could you elaborate more? What do you see in the development of AI in the stock market trading or research? How that will impact how people do their research and trading, and how people maybe for risk managers, how they have to adapt to face this challenge?
Yeah, I mean, I think the biggest piece that I see is sort of the co-pilot use of AI. Go get me this information. I want to, read a 200-page report, but I don't want to actually read it. So I can just enter into a little chat-like interface, what were the key points of the report? And I get my 4 bullets, and maybe I copy paste those and bring them to a meeting, or I use them for investing. I think that's going to be, 80% of the use case. Going forward, I think that there are certainly some hedge funds that I see that are developing or have AI capabilities for the purpose of, automating trading, based upon momentum, but also based upon lots of different indicators and correlations between macroeconomic data and, what the market usually does. For example, if we get a good, CPI report, like we did yesterday, where it says, you know what,
Mhm.
inflation's actually coming down a little bit. You can automate that with an AI to read that, analyze it, say, okay, stock price, of the QQQ and the NASDAQ rose 1.5% the last time there was a positive readout. So we can train our algorithm to trade to, a 1.2% gain that day. Things of that nature where you can automatically respond to the market. We certainly see that. And then, the decision analytics side, like we're doing, where it's not just a matter of, acting quickly, it's making a smart decision, making the right entry and exit points and having more precision over, what normally happens for situations, special situations like we cover with events. But we also see that just generally, with valuations. It can be a little bit tricky to monitor for opportunities when valuations get a little hot relative to history. And there's a lot of things to keep track of as an individual investor. So AI can certainly ease that burden, looking at things like when the PE ratio of a company exceeds its historical 5-year, let me know, because it's time to
Mhm.
trim for my portfolio. And so AI is now being developed to sort of automatically rebalance portfolios on the basis of valuation, on the basis of sector performance. So if, and you're kind of seeing some of the movement right now, right, where tech was outperforming for a while, but if you look closely, financial companies are outperforming in the market as asset managers rebalance their portfolio, because the tech company got really expensive. There's a lot of manual process to that, but there's also a big movement to automate that, to say, you know what, we're switching because tech is overvalued, so now we're going to buy the cheaper stock sectors, which are utilities, banks, and so forth. And over the last, like, I think, month and a half, utilities have really outperformed financial services, and banks have really outperformed the broader market and some of the other industries that had been hot. So it's a lot of that, shortcuts, not having to monitor your screens so often. I think it's healthy for people. I think that hopefully, maybe we could lower the number of work hours that we have, particularly in the US on average in a week, get back to doing some more things outdoors and let some of the machines monitor. That's my hope. We'll have a healthier society if it comes to fruition.
All right. So what do you see as a major misconception in your field that you kind of strongly disagree with?
I think the biggest one that I see is that AI will solve all their problems or kind of print money like an ATM.
Oh,
There's a lot of
it would be
users that,
nice.
yeah, it would be nice, that have high hopes that, that there's just a magic algorithm that will consistently outperform and make money. And the reality is that might happen for a short time, but the market is constantly changing. So what works for 3 months is probably not going to work for 12, which means if you have that black box algorithm, there's going to be times when it absolutely backfires and doesn't work. And you see that, like in a bull market, when everything's going up, sure, that can work fine to do momentum based AI algorithms and say, hey, this company just broke through its 50-day moving average with its 20-day moving average, and that's always a bullish signal, so I'm going to buy there and hold. And that works great when everything's going up, but not so much when things are going down, not so much when global events are happening, when governments are changing policy. So I think the biggest misnomer out there is like the AI will solve all my problems. You still have to be able to think, and you still have to be able to understand how to apply it in different circumstances.
Mhm. So what you said in the beginning that you wanted to share something about buy and hold strategy because people like Warren Buffett said it was a great strategy.
If you can pick the best stocks that ever were on the stock market, it's a wonderful strategy. Most people can't, and most companies, don't continually go on to make new all-time highs. In fact, they have a lot of cyclicality to them. And so my general view is if you have unlimited amounts of time to wait and never need access to your own money, yeah, you can buy the indexes, hold, and
Mhm.
never sell, and just keep adding to your position. But I don't know that many people that have never needed access to their money. You know, things come up. You need to pay for college, you need to buy a house, you know, fix a house, you need to buy a new car, whatever. And so if you're constantly exposed, you know, if you're 100% in the stock market or even 80%, all of that money is exposed to risk. And there's constant risk. There's risk of the company not performing. There's risk of the company having some kind of legal issue and being sued, whether it's copyright violation or by the government for antitrust or environmental justice reasons. There's risk on a global scale, war, conflict, you know, one country invades another. There's risk from weather, from famine, from drought, you know, that can affect markets all over the place. Policies are constantly being shifted, you know, tariffs back and forth between the US and China.
Mhm.
And so it goes. And so the longer you're exposed to markets, the more risk you're actually incurring. And so my particular view is you can have some long-term risks for money that you don't need to touch if you have a long enough timeline. But for most people and most other people and those who are kind of closer to retirement age, you're not going to be able to withstand a period like we had from 2008 to 2016, where the market didn't do anything except stay the same. You know, went down and for years had, you know, no profit and took 4 years to recover from the '08, you know, financial crisis. You might not have that kind of time to recover. So
Mhm.
you have to look at kind of what your target return is. If your target return is something like 6 or 7% per year, and you're exposing yourself to all these risks over a 365-day period, I don't think I don't think it's the right risk mitigation approach when you can make 6 or 7% in 1 or 2 days by trading events, then put your money
Mhm.
back safely into a different asset, either cash, gold, you know, something else that's a lot less volatile, and not be exposed constantly to these ebbs and flows of political
Market.
whims and what's going on, you know, with the earth and the planet and what's going on with global conflict. I think, you know, between COVID, you know, multiple wars, and lots of different, you know, tariff wars and policy wars that we've had over the last years, it's tough to make an argument that being in the market all the time is the best strategy. And you could look at individual stocks like GE, which was the biggest market cap stock in 2002, and now it's in
Mhm.
a bunch of different pieces and collectively just barely broke through the price it was in 2002, 22 years earlier. You know, and you see
Mhm.
that again and again. Look at Pfizer. It was crushing it 2 years ago. Now it's half the
Yeah.
price. So, you know, I can't say that buy and hold is a wonderful strategy for everything. If you were lucky enough to get into Apple and Visa and Microsoft early, great. But you know, for most of the market, I think we're looking at coming in and out.
Just to keep market, U.S. market is always uh, doing better than other countries, I think,
I
for
do
the
think
last
at the U.S.
few.
markets, yeah, it's definitely the safest investment historically, for sure. But it is subject to the same kind of pullbacks.
Okay. So, Andrew, so if we summarize our interview for someone who's listening, what do what do you like? Maybe you can share two major takeaways for them. What would it be?
Sure. If you are into investing and kind of lowering your risk and increasing your profits, I would recommend checking out levelfields.ai. We do event-driven investing. It also helps automate the entire investment research process, making it simpler and giving you more access to more visibility to more stocks. And I think that even if you're a long-term investor, you're going to find opportunities there that you would have never thought of and certainly make back, you know, the couple $100 a year subscription that's required.
Okay, if you compare it with Bloomberg, makes sense. All
And
right.
yeah,
So thank.
Bloomberg is about what, $25,000 a year, and it's all data, not a lot of analysis there. So you could use the terminal, find the news, but you're still going to have to do all your own analysis. We do it for you. And we
Okay.
have a very simple to use interface, so it's not quite the learning curve of going back to a 20-year-old technology system.
All right. Thank you again, Andrew. Well, fantastic. Those were all my questions. Perhaps if I forgot to ask you any questions, you can just go ahead and that you think what is important to our audience that I forgot to ask you.
No, I think we hit it all. Just say if you want to check out levelfields.ai, go to the website, levelfields.ai. We have a promotional code for podcast listeners for your show. Just put in the code podcast 23 with the number 23, and you get a pretty significant discount to check it out. And it might be great, let people know we exist. Even if you
All
don't
right.
think this is for you, tell a friend.
Thank you again.
Thank you. Appreciate it. Thanks for having me.